Good morning and welcome to the Providence Quarterly for March 2020. I'm joined by Grant Patterson, the CIO and founder of Providence Wealth Advisory Group. Welcome, Grant.
Thanks, Mike, and welcome to the home studio.
Thank you. And Grant, firstly, how are you?
I'm doing fine, thanks, Mike. Safe and well. It's been a very, very intense 5 weeks. A lot of moving parts. So it's been quite intense, I'd say. But I'm well, family's all back together and safe and sound, so I'm doing okay, thank you.
That's good to hear. Now, back to markets. There's been a lot going on in the last couple of months. Given your history, what are your observations about this current market?
Well, Mike, you don't normally get a big dislocation like we've had without further ramifications, and I call it the second or third derivative. This is very similar to 1987, where we saw a very sharp fall in markets and a very quick rebound. But the repercussions of that volatility didn't really flow through to all asset classes till 6, 9, 12, 18 months later. And similar in the GFC, the repercussions of that. So I would caution that, you're likely to see some stresses across asset classes as we move on. And it's very important, in my view, to ensure that to take advantage of those opportunities, you have a high level of liquidity or cash and retain that to take advantage of those opportunities.
And Grant, in regards to valuations, we believe that valuations matter. Where are we in terms of valuations across the asset classes?
Well, Mike, in our last quarterly, and it was only 3 months ago, and that seems like a decade ago, we were cautious about valuations. We felt that valuations were stretched across all asset classes. We saw some cracks starting to work in the functioning of markets. And so it was paramount to us to make sure that your capital was protected and preserved in such a overvalued market. So 3 months later, the COVID-19, I think, has been the trigger for the readjustment of valuations. So where we are now is we still don't believe that valuations are cheap. Now, it really comes down to what you think the earnings recovery is going to be like in the economy. But in the equity market, for example, the market is factoring in a 15% decline in earnings. We think it's going to be larger than that. But at 15% decline in earnings at the average PE, the market is fair value at best. If you start factoring in a 30% decline in earnings and start requiring a higher risk premium for taking the risk, then the market still has 20 or 30% potential downside. We may actually retest the lows. So we're cautious on that. Same in credit. The credit spreads blew out. But the stunning announcement from the US Fed, injecting $2.3 trillion into the economy to keep liquidity going, and even buying junk bonds, was stunning. And so the credit markets have taken comfort in that. But we're going to see credit defaults. We're going to see companies under stress down the track. So it's not yet at a level where we think is worthwhile committing much of that hard-earned capital and cash.
Grant, there's been a big shock to global growth. How do you see that recovering?
I find it very difficult to believe that once the virus is contained or there's a vaccine, that the world just goes back to the way it was. There's structural damage that's been done to industries. So unemployment is likely around the globe to be higher than what it was going into this. And I think companies will be, very cautious, very austere, if you like, because of the debt levels that they've had to build up during this period of time. So I find it very hard to have the view that we're going to rebound strongly from these sort of levels. And I think it's going to take many, many, many years. It's going to be quite a hangover from this unprecedented time and dislocation in global economies to recover that quickly. So my view is a long, hard workout, and certainly if you speak to people in business and their own businesses as opposed to the equity markets, business owners are very concerned about how long it's going to take to rebound back. So I think a long, hard road ahead of us.
Given the valuation uncertainties, whereabouts are you seeing opportunities?
We're not seeing a lot at the moment, Mike, to be honest, because there's just very little transparency. And so we really need to be a bit more certain in regards to what the damage to the economy is going to be long term. I don't believe it's going to bounce back as quick as what the markets think. I think opportunities will start showing themselves, as I said, in the second derivative or so, in distressed debt, in distressed credit. I think there'll be some opportunities in refinancing. I think there'll be some opportunities in distressed property. You've already seen the A-REITs, the listed property sector, impute valuations down 15 to 20% in retail and commercial. That'll flow through to the direct market, and I think there'll be opportunities there. And we're also quite comfortable owning first mortgage, fully secured loans for completed product.
Thank you. And Grant, any update on Providence?
Mike, all the team are well, working well from home. As we've said from the beginning, isolate but communicate. So given technology and the video meetings, we're all keeping in touch. Everyone's well, keeping safe, but we are all looking forward to getting back into the office environment.
Grant, thanks very much for the update.
Thanks, Mike.
And thank you for joining us, and we look forward to seeing you next quarter. Thank you.